Howdy, folks. Welcome to Liberty Call. Today is Friday. Woohoo! End of the week. It is June 21st, 2024. I am Raymond Dahlman, your humble host here at the Liberty Call. Looks like the markets took a little bit of a step back today. I mean, the Dow was flat, but the rest of them were a little more down. And the rest of the world, I see a lot of red too. So was not a happy day here at the end of the week. So, all right. It's kind of an overcast day here in Colorado. We got clouds and a little overcast, and may get some rain here coming up. So I've got to go run some errands when this is all done. So I'm going to go run to town, get some groceries and stuff. So anyways, all right. If it is your first time watching a Liberty Call, if you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. All right, let's go ahead and get into today's numbers. Dow Jones was barely up 0.04%, 15 points, closed at 39,150. The S&P 500 was down 0.14%, 7 points, closed at 54,65. NASDAQ down 0.16%, closed at 17,693. The VIX fell 0.68% today. It's at 1319. Canada was down 0.12, Brazil up 0.84, and Mexico down 0.98. Western Europe, Germany was down 0.38%, the UK down 0.42%, France down 0.56%, the Netherlands down 0.92%, Spain down 1.15%, Italy down 1.09%, Switzerland down 0.84%, and Portugal down 1.21%. Russian exchange, the MOEX was down 0.05%, and the RTSI is still closed. And the Asian markets, the Nikkei in Japan was down 0.07, Australia up 0.34%, New Zealand down 0.7%. In China, the Shanghai was down 0.24%, the Shenzhen Component down 0.04%, China A50 down 0.78%, DJ Shanghai down 0.18%, Hang Seng down 1.53%, and the Taiwan weighted down 0.65% for the day. So, all right, well, let's go ahead and bring up our weekly chart and see how things did. Looks like the Dow Jones had a pretty decent week. Let's see here. Dow Jones was up about 1.55% for the week. The S&P 500 looks like it's going to finish up about 0.56%. And the NASDAQ looks pretty flat. Down 0.07 as of right now. There's a few more minutes left before, because this is 15 minutes delayed, so it's going to take a little bit. So Dow Utilities is going to finish in the red by about 0.41%, and the Dow Transports, those look good. They're going to be up about 2.14. That's a big one. So of the majors, the Dow was up about 1.5%, the S&P about 0.5%, and the NASDAQ slightly down. So all right. Well, that is the markets for the week. Let me get that off my screen so we can see what we're talking about. Okay. All right. Let's get to the economic data that came out this week. Starting out with jobs. Initial jobless claims came in at 238,000, a little over the forecast of 235. Last week's number was 243, so we came back a little bit. Continuing claims came in at 1.828 million. Forecast was 1.81. So a smidge over forecast there. And last week's number was 1.813. So up about 15,000. The New York Empire State Manufacturing Index contracted at 6.0. Forecast was a contraction of 12.5. And last month's number was a contraction of 15.6. So some improvement. If you look down here at the chart, we've got a little bit of an improvement here on this index. Retail sales year over year grew at 2.27%. Last month's number was 2.74, so a little bit of a slowdown there. And the month over month growth was 0.1%. Forecast was a growth of 0.3%. Last month's number was a contraction of 0.2%. Industrial production grew at 0.39% year over year. Last month's number was a contraction of 0.68. And the month-over-month number, industrial production grew by 0.9%. Forecast was 0.3. Last month's number was flat at 0. All right. Housing starts, let's see, came in at 1.277 million. Forecast was 1.37. And last month's number was 1.352 million. And housing starts month over month contracted at 5.5%. Forecast was 0.7 growth, so a bit off there. And last month's number was a growth of 4.1%. And existing home sales came in at 4.11 million. Forecast was 4.08. And last month's number was 4.14 million. The month over month number grew at contracted at 0.7. The previous number was a contraction of 1.9%. All righty. Well, that was everything there. Let's go ahead and dive into the market recap. U.S. stocks struggle for direction as Nvidia continues to ease from the recent peak. All right. Let's see here. Yep. All right. All right. On Friday, U.S. stocks experienced mixed movement, particularly within the tech sector, as investors reassess their positions in Nvidia and other major companies. Nvidia Corporation fell over 2%, marking the second consecutive day of decline following its brief stint as the most valuable company, surpassing Microsoft. Nvidia's market valuation settled at $3.14 trillion, trailing Apple's $3.23 trillion and Microsoft's $3.33 trillion. Despite the dip, the optimism surrounding artificial intelligence applications suggests robust underlying demand for Nvidia's stock. In other news, Boeing saw a modest rise in its stock price after reports from Reuters indicated that the aerospace giant is nearing an agreement to repurchase Spirit AeroSystems, its former subsidiary. Spirit AeroSystems, which served over 5% on the news, has been a crucial supplier for Boeing since its spinoff in 2005. However, negotiations have faced hurdles due to Spirit's commitments to Airbus, Boeing's main competitor, which has opposed any deal that would involve Boeing manufacturing parts for Airbus's latest models. Meanwhile, CarMax experienced a 1% increase in its stock after reporting better than expected first quarter profits, despite a 33% drop from the previous year. However, its sales figures fell short of analysts' expectations. June's manufacturing and purchasing managers index readings exceeded economists' forecasts, indicating continued economic strength. May's existing home sales data also surpassed expectations. Federal Reserve officials have expressed caution regarding imminent rate cuts, highlighting the need for more definitive evidence of inflation control, which they have none right now. Richmond Fed President Thomas Barkin emphasized the importance of gaining more clarity on the inflation trajectory before considering any reduction in interest rates. Lastly, volatility is anticipated as this trading session approaches triple witching, a quarterly occurrence when stock options, stock index futures, and index options contracts expire simultaneously, often leading to increased market fluctuations as investors adjust their positions. All right, so good stuff there. Got a little data on the May home sales, existing home sales. This comes from our friends over at First Trust. Mr. Bryce Gill, an economist, is who published this. All right. May's existing home sales report revealed a 0.7% decline, marking the third consecutive monthly drop, highlighting the housing market's ongoing struggles with affordability. Persistent headwinds, including mortgage rates exceeding 7% and rising home prices, with the median price of an existing home increasing by 5.8% year over year in May. This combination has led to a 43% increase in monthly mortgage payments for the median home since the Federal Reserve began its tightening cycle in March of 22, assuming a 20% down payment. Now, if you hadn't printed all that money 4 summers ago, we probably wouldn't have all these inflationary problems that the Fed is now trying to put out. But hey, what do I know? The housing market is expected to adapt to these higher costs eventually, but continued volatility in financing costs poses challenges. Interestingly, sales of homes priced at $1 million and above have surged by 22.6% over the last year. Yeah, because people with money are moving away from bad places, contrasting with a 2.8% decline in overall existing home sales. This trend indicates that the upper end of the market is adjusting more readily to higher rates. However, many existing homeowners outside of the luxury segment are experiencing a mortgage lock-in effect, having purchased or refinanced at lower rates before 2022, making them reluctant to sell and limiting future sales and inventories. Yeah, well, I mean, people who are buying million-dollar properties where I live are just average homes. I mean, I live in a neighborhood where homes go for anywhere from $700,000 to I don't know, $2-3 million. So, I mean, it's all custom stuff where I live. So, all All right, let's see. Finishing up, despite these challenges, there are signs of progress with inventories rising by 18.5% over the past year, yet the month's supply of homes, which measures how long it would take to sell the current inventory at current slow sales pace, was 3.7 in May. This figure remains well below the 5-month supply benchmark used by the National Association of Realtors to denote a normal market. The tight inventory of existing homes suggests that while the pace of sales is reminiscent of 2008 market downturn, it has not led to a significant decline in prices. This dynamic underscores the unique nature of the current housing market, which where limited supply continues to support prices despite slower sales. Yeah. Again, the Fed will point the finger at everybody. The government will point the finger at greedy business owners. The reality is, it's the Fed who created this problem by printing all that money. If we didn't have all that money in the system, prices wouldn't have exploded like they did. All right, last up comes from our buddies over at Mises Wire. The state wants to nationalize second mortgages. What could possibly go wrong? This was written by Artis Shepard. Recently, Freddie Mac, a government-sponsored enterprise, sought approval from the Federal Housing Finance Agency, FHFA, to purchase and guarantee second mortgages in the United States. This proposal, seen as economically and politically driven, could have significant implications. In the U.S., the single-family mortgage market is heavily influenced by government entities. Freddie Mac and Fannie Mae, the two major government-sponsored enterprises, own or guarantee 70% of home mortgages, including the Federal Housing Administration and related agencies. These figures rise to approximately 95%. This extensive government involvement aims to promote widespread home ownership, making mortgages more accessible, but also driving up home prices. Freddie Mac and Fannie Mae, although nominally private, were created by Congress to provide liquidity to the home mortgage market. They have been under significant government oversight, particularly since the 2008 housing crisis, where they were placed into conservatorship under the FHFA. Second mortgages, such as home equity lines of credit and home equity loans, allow homeowners to access the equity in their homes. These loans are riskier than first mortgages because they subordinate the existing mortgage, typically smaller, and carry a higher interest rate. Freddie Mac's request for approval to hold these loans suggests a move towards nationalizing the second mortgage market, similar to the existing first mortgage market. Yeah, because what could go wrong? Seriously, folks. The proposal comes amid a housing bubble and high consumer debt levels. The Case-Shiller U.S. National Home Price Index remains at all-time highs, even as consumer debt rises and real wages stagnate. Politically, this move is to encourage homeowners to borrow against their home equity, because what could be a better idea than leveraging your house to the gills, and then when the economy crashes, you're then upside down. You can't afford to pay off your house, and then the bank gets your house. Don't do it, folks. Not a good idea. Let's see here. Politically, this moves... Okay, yeah, we talked about that. However, this could exacerbate the already high levels of household debt, particularly affecting lower and middle income segments, where 36% of adults have more credit card debt than emergency savings. Yep. You need at least a 3-month cash reserve, folks. Critics argue that true market demand should drive the availability of the second mortgage liquidity, not government intervention. They warn that increased government participation could lead to malinvestment. No. And further issues with asset inflation and household indebtedness. A healthy market, they contend, is created by individuals acting in their own interests, not by government mandates aimed at short-term political gains. All right. Good stuff. I know. I saved all the good information for Friday. You're welcome. All righty. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. If you need to get your financial crap together, give me a call, shoot me an email. I'd be happy to help you get you back on track. All right. Well, that's everything I had for today. Like I said, hope everyone has a fantastical weekend, and I shall talk to you again next time. Adios. Wrong one. Let me stop. Wrong one. Here's the credits.